Disaster struck Wall Street in October of 1929. Consumers' spending on big-ticket items hit a slump, causing several key stocks to decline. The drop sparked a rash of margin calls, where brokers demanded that investors put more cash into their stock market accounts. This was the risk of buying stock on credit. When a stock shrinks in price, it's no longer valuable enough to be collateral for the loan. Investors must put up cash or margin to even the scales. If they don't, their account will be liquidated. October 24th, 1929. Thousands of investors failed to come up with the necessary cash by the time their brokers entered the exchange. When the opening bell rang at 10 a.m., the liquidation sale began.
Well, it started off, as I recall, like a busy day, and pretty soon it got worse and worse.
Suddenly, it appeared that everyone wanted to sell and no one wanted to buy, and there was a sense of frenzy.
The credit binge that had built up the market was suddenly eating through it like a virus. The imbalance between sellers and buyers pushed all stock prices lower, forcing margin calls on other investors and more liquidation.
So it's a cascading effect. In other words, selling causes selling, causes selling, causes selling. And no one can see the bottom.
You just got a lot of people yelling, screaming. The place was a bedlam. I can't describe it except to say that it was out of control.
So many shares were sold so quickly that the ticker was running 4 hours late. Thousands of investors flooded the financial district, desperate for news. And suddenly there was hope. Richard Whitney, vice president of the exchange, met with the nation's top bankers and marched onto the trading floor.
And he walks up to U.S. Steel and says, "What's steel at?" And he says, "200. I'll buy 10,000 shares of steel at 200. And a roar goes up. The big guys are coming in. They're saving us.
Whitney bought $20 million worth of stock in a matter of minutes. It was a powerful symbol.
Recovery, resistance, hope. Don't forget, these people are seeing the whole place fall to pieces. And here's a guy who steps up and starts showing courage.
It turned out Richard Whitney was not trying to save the market, but to fool it, so the banks could eventually sell out at a better price. His triumphant stand stopped the panic temporarily, but the downward spiral resumed the following week with a bigger crash and continued for the next 3 years. The drop was staggering. General Electric went from more than $1,600 per share to $154. General Motors, $1,075 to $40. The Dow Jones Industrial Average fell 89%. $72 billion in investments wiped out.
And people who had their whole life savings tied up on Wall Street vanished. It's out. No more. Zero. A person went from $500 to $15,000, and now he's down to zero.
Economists contend the crash alone didn't cause the Great Depression that followed. But the public blamed Wall Street. The panic frightened people, and as they stopped spending money, the economy ground to a halt.